you then over extrapolate on the downside. If this continues, crypto is going to zero. All of my savings that I've been dollar cost averaging, listening to Tom and Raoul, all bullshit. This has been a scam. So if you look at Amazon warehouses, Amazon is employing robots at a faster rate than humans.
Raoul Pal is the CEO of Real Vision, a financial media company and a macroeconomic expert. In this highlight, Raoul Pal reveals the biggest misconception that all amateur investors get wrong about crypto and the reason why so many will lose money on their investments. Once you understand this essential concept, you'll have far more gains than losses on your crypto investments. Be sure to watch until the end because Raoul Pal goes on to expose the sad reality about baby boomers that no one wants to talk about.
So there is an expression, Warren Buffett's used it, is when the tide goes out, you see who's swimming naked. So the tide out in this is liquidity. And liquidity is driven by central banks trying to stop inflation. So they raise interest rates when they think there's inflation. It slows down the economy. It's harder to borrow money. The whole economy slows down and we restart. It's called the business cycle. And you and I have talked about this in the past. So the economies are cyclical. They're naturally cyclical because the credit cycle, even without central banks, is you kind of lend or borrow too much money, then something happens at the margin and you're like, oh shit, I borrowed or lent too much money, and you pull it all back again and then you do it again, right? So the central banks try and soften that cycle, but they still create it and use it to try and not let economies go too far, like hyperinflation or depression, whatever it is, right? So that's what they're trying to do. That cycle drives the movement of asset prices. And so that's the stock market, the bond market, equity market, the currency market, the crypto market. And with that cycle becomes the human emotion cycle. And the human emotion cycle is, I'm making a fortune. I'm a genius. I can never go wrong. I'm going to be rich. Extrapolate. Future vision of myself is now going to be driving a Lambo and, etc. And if you think about it, and that's exactly what happens to all of us, and we have to fight that demon, is you start extrapolating out and you start thinking, my vision of my future self has now been ratcheted up. So investments are just a manifestation of your future self, right? That's what we're trying to do. So you got that vision of what you'd like to be, and to get there, you invest because that will deliver that. So if your investments do well, you start stupidly readjusting yourself higher all the time. So then what happens is, when the market goes against you, you have to go through the emotional inner journey of, oh, maybe I won't get there, right? That's really hard for people. It's emotionally really hard to kind of plant a flag on that's what my future is definitely going to be, definitely, because I'm really good at this investment game, to I was completely wrong. And what happens is you then over extrapolate on the downside. If this continues, crypto is going to zero. All of my savings that I've been dollar cost averaging, listening to Tom and Raoul, it's all bullshit. This has been a scam. It's the exact opposite. But when you step back, you take a nice logarithmic chart of Bitcoin, and anybody can do that on TradingView or any of those charting things, and it's a nice, smooth upward trend, which is the adoption of cryptocurrencies and blockchain technologies as a new financial system and a way of exchanging value on the internet. In the middle of that, on a log chart, it just looks like it slowly does that. On a linear chart, it looks like this. But no, it looks like, more correct, it does this, collapse. And what happens is everybody goes, when it goes up on a linear chart, everyone goes, it's a bubble. People who aren't involved. Then we all get to the over extrapolation of like, we're all going to be billionaires, let's order my Lambo. Then it starts coming down, it's denial, typical, the human phases of emotion. And then you get to anger and despair, which is where we are now. But that's all, that whole story of humanity, liquidity, central banks is all within this long, smooth uptrend that keeps going. And people forget it. They forget it at the bottom and they forget it at the top. And it's as simple as that. So to go back to what you were suggesting, has anything changed in the crypto market? Not a thing. Is the technology being utilized? Has Solana just agreed to use their blockchain with Meta for NFTs? Yes. Are Google working with Solana? Yes. Is Ethereum being built out? Did DeFi fail? No. Does the decentralized financial system idea work? Yes. Are cryptocurrencies being exchanged in a value system on the internet? Yes. Is the number of people growing in that ecosystem? Not a lot, because it's stabilized. But if you look at the past cycle, so the 2017 peak to the low in 2019, we lost about 80% of the active wallet addresses.
Wow.
When I look at it now, we've lost about 30 because the adoption keeps rising. So it really is a psychological game, and it's a long-term game because, and you've talked about this, is we're not involved because we can make money over a 1 year time or a 2 year time. We're saying, listen, the bet here is if you hold on and if you add at the bottom of the panic cycle and just keep holding and don't use leverage and just be sensible about what you're doing and don't keep checking the market every day, the probability of you coming in at the end of the decade and having manifested your future self in a way that probably might be quite unexpected. And if you do that, you won't go through that emotional journey. So there's a few things. First, velocity of money is, as you say, but it's a demographic phenomenon. So velocity of money has been super low since 2000.
So not influenced by the Fed?
No.
Interesting. Whoa. Okay. Shocking. You're smacking my worldview around.
They have not been able to.
Interesting.
Because psychology. Who is hoarding money? Baby boomers. The same people who cause the inflation are causing the deflation or disinflationary trend. Because they're hoarding money because they're now 75 years old. And all you want to do is make sure you don't die destitute at 85 or 90, right? Imagine if you're homeless at 85, right? So you are driven by one of the strongest psychological factors you have is, I cannot get any worse than I am today, right? So you're a hard stop. So you won't spend. So the baby boomers have stopped velocity of money. And I've proven this with charts over time that that's what's causing it. That's why we've got this disinflationary trend in the world, even though we're in a temporary inflationary trend. And it's been that the Fed have debased currency to try and offset. But the baby boomers, with the debasement of currency over time, found that their income didn't go up, but the assets did, because there was too many of them competing for these assets. This is before debasement. And so they borrowed money to fund the gap. When we started the big debt boom, it was all driven by this demographic. So yeah, go and check out that video. I think it's pinned to our YouTube channel. That's a big issue here. It's a bigger issue with this demographic game, because that's one of the rules of the game that you can't change.
So what happens over the next 15 years as boomers start dying?
They will get, firstly, more propensity to not spend. So when my dad retired, Dad used to quite like spending money. He was reasonably, he was a middle class, did reasonably well, not phenomenally well. And what happened the moment he retired, he's like, fuck, this is a fixed sum of money. I don't know how long I'm going to live for, and my wife's probably going to outlive me. So his spending pattern probably in 2 years fell 65%.
Wow.
He was the guy who'd buy champagne. He'd go out for dinner with friends, buy a bottle of champagne, whatever, blah, blah, blah. By the time he hit 76, he'd be on the €5 special at the supermarket because he just didn't want to not run out of money. The worst thing for him is him to die, which he did, and leave my mum with no money, because then his whole sense of self is tied up in it. So anyway, so it's really strongly driven by these kind of things. So I think as they get older, it actually gets worse.
But they are going to die. So we've got, I'm going to guess, 15-ish years, and then they start dropping like flies.
That's right. And so then we've got the other issue, right, which is depopulation of the world, right? That's coming at scale. But this gets offset by technology. So if you look at Amazon warehouses, Amazon is employing robots at a faster rate than humans. And the robots, there's now 500,000 of them, and 1.5 million people work for Amazon. But the robots work 3 times as many hours and are probably twice as productive. And they never have a holiday, nothing, right? So that's going to happen at scale and replace the baby boomers.
But what's going to happen when the baby boomers' money floods into the system? I mean, I heard some crazy number about how much money baby boomers have locked, but they're going to give that, charity, kids, whatever, but it's going to come in a pretty rapid
I've heard
clip.
This story before. There's one economy that's led everything. That's Japan. The issue is that people start living longer. The Japanese actually passed on the wealth to their retired kids.
Whoa.
That was the problem. Because if you lived to 90 and you had your kids at 20, your kids are 70 by the time you die.
Wow.
And so they didn't get the wealth effect of the changeover in wealth. Now, not every economy is as long living as Japanese, and the Americans are 42nd longest living. It's inexcusable. Considering GDP, how much they spend on healthcare as a percentage of GDP, it's inexcusable what happens in the US. But
you just can't eat like that. I'll just say it.
Yeah, you can't eat like that, and you can't have the drug companies involved as far as they are. So I don't know if there's a big wall of money coming, Tom.
That's almost more scary.
And I think people's jobs get replaced by technology. But I think there is a productivity boom, which we've not had for a long time because of this retired population and debt. I think this, what I call the exponential age, this rise of technologies, may give us more wealth per GDP.
If you enjoyed that video, click here to watch Michael Saylor reveal how he thinks the future of Bitcoin and cryptocurrency will be after the FTX crash.